Today's rally wasn't just a rebound in prices. It reflected a sharp shift in how investors are thinking about risk, policy, and the path forward. Markets staged a powerful relief move across the board. The Nasdaq surged more than 3%, the S&P 500 climbed close to 3%, and the Dow added over 2%. Volatility dropped sharply, with the VIX falling more than 17% as investors unwound defensive positions. At the same time, bond yields eased and the dollar weakened, both signaling a shift in policy expectations. But what stood out most was in commodities. Oil pulled back decisively, dropping below recent highs, while gold surged to new record levels. So this wasn't just a risk-on day, it was a broad reset in positioning. What changed was the narrative investors are pricing. After weeks of escalation, markets suddenly saw a path toward de-escalation. There were credible signals of a temporary ceasefire and the creation of safe shipping corridors through the Strait of Hormuz. At the same time, early data suggested that shipping activity is beginning to pick up again, not fully normalized, but no longer frozen. That matters because the worst-case scenario, a prolonged system-wide energy disruption, started to fade, at least temporarily. And then there was the policy shift. The Federal Reserve signaled that rates are in a good place, with no urgency to tighten further despite the recent energy shock. That combination changed expectations quickly, from prolonged conflict and tighter policy to potential de-escalation and a more patient central bank, and markets reacted accordingly. So how did capital respond? This was a decisive rotation back into growth. Technology led the rally, followed by consumer discretionary and industrials, the areas most sensitive to rates and economic expectations. Financials also moved higher, reflecting renewed confidence in system stability after recent stress signals eased. At the same time, defensive positioning was aggressively unwound. Energy stocks declined as the oil risk premium compressed. Utilities and staples lagged as investors moved away from protection. But there was one important nuance. Gold rallied strongly, even as equities surged. That tells you this isn't pure optimism. It's a more complex positioning. Investors are adding risk, but still hedging uncertainty. Beneath this relief, there are still fragilities that markets may not be fully pricing. The first is the reality of partial reopening. Yes, shipping is resuming, but volumes remain far below normal levels and access is still selective. So the supply shock isn't gone, it's just less extreme. The second is inflation pressure. Energy prices may have eased today, but they remain elevated, and we're already seeing signs of that feeding into consumer prices globally. That creates tension for central banks, because while policy may pause for now, sustained inflation could quickly bring that pressure back. And finally, there's the fragility of the diplomatic process itself. What markets are pricing today is progress, but not resolution. So what is the broader signal here? This looks less like a full regime shift and more like a powerful narrative reset. Markets are moving from pricing worst-case outcomes to pricing a more balanced scenario where policy holds steady and growth stabilizes. But the underlying constraints haven't disappeared. Oil is still elevated, inflation is still building, and geopolitical risk is still present. One open question investors are debating right now is whether this rally reflects a durable shift in the outlook or simply a relief move driven by positioning. I'd be interested to hear how you see it. Is this the start of a more stable phase or just a temporary reset before volatility returns? Looking ahead, several key developments will test this narrative. The first is incoming economic data, especially labor market and inflation reports, which will shape expectations around policy. The second is central bank communication. whether other officials reinforce this more patient stance. And the third is geopolitical follow-through. Do shipping flows continue to improve, or does disruption return once temporary agreements expire? These are the variables that will determine whether today's move can sustain. The broader takeaway from today's market reaction is that investor positioning remains highly sensitive to shifts in expectations, particularly around policy and geopolitics. What changed today was not the underlying reality, but how markets are choosing to interpret it. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you find this type of calm, analytical breakdown useful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And thank you for spending a few minutes here today.